Hello and welcome to the CNBC-TV18's Mumbai studio. I'm Sonal Bhutra and you're watching MF Corner. Today, we put focus on Gilt Funds for our viewers. These are mutual funds that invest money in fixed income government securities. In fact, Kotak Gilt Fund has also completed its 25 years since its launch. So that's a big achievement and a milestone as well. The fund has delivered CAGR of 8.99% since inception. To talk more about Gilt Funds, how important they are for retail investors, what are the advantages and what are some of the risks associated here as well, we have with us Nilesh Shah, Managing Director at Kotak Mahindra Asset Management, and Abhishek Bisen, the Head of Fixed Income at Kotak Mahindra AMC. Gentlemen, thank you so much for joining us today in the studio. And this is a less spoken about category as well, but we were talking about how it balances the portfolio in general. First up, congratulations for 25 years of the Gilt Fund at Kotak AMC. Nilesh, let me start with you. How are you looking at Gilt Funds right now? There's so much central bank action happening globally. We are talking about a possibility of cut in interest rates. How is this category looking like?
So as of today, this is probably the best category to invest into in fixed income. If you see the fixed deposit curve, which is kind of preferred investment option for investors, it's kind of inverted. What you get in 1 year, you don't get for 3 years and 5 years. In the government securities, the yield curve is still positively sloping. You get more for 30 years and 10 years than 1 year. We expect interest rates to come down. So anyone investing for the longest possible duration should do well. And Gilt Fund provides that opportunity.
Okay, so it is the right time to invest in Gilt Funds. Abhishek, let me come to you. When we are talking about investing in Gilt Funds or fixed income, let's first focus on the smaller category. What are some of the benefits of investing in a Gilt Fund for a retail investor? And what should they keep in mind while they're investing in Gilt Funds? Because we do see more acceptance coming in from corporate clients, not so much from retail. So what are some of the things they should keep in mind?
So first and foremost, they have to understand that how the fund works exactly. Something called mark-to-market risk, but since it's an assured underlying, it's government security, you're not going to lose your capital for at all if you keep your investment for a reasonably long period of time. So that is first. Now, second, you have to be okay with the volatility, but you are going to get your cash flows over a period of time. But at the same time, since this is a assured category for your long-term investment, you should keep in mind this segment is going to go towards your retirement. So you have to, in your asset allocation, you have to keep this category. And other thing at this point in time, as sir was highlighting, that the curve is positive sloping, and since we are going in a fundamental shift, for all you know, 5 years down the line, you are not going to get these rates. So it's good time to lock in for a reasonably long period of time so that you can keep getting your long-term annuities at current level of interest rates.
Okay, Nilesh, is there a reason why we do not see so much interest or retailers are a little awry when it comes to investing in Gilt Funds? Why is it not so popular?
So it's a very good question, Sonal. And I think people are not comfortable with mark-to-market. In bank fixed deposits, they know this is where I have come in, this is where I will exit, and everyday prices are going up, or there is a linear curve. In government securities fund, there is mark-to-market volatility, but as I jokingly tell people, ECG better should be moving up and down rather than a straight line. Same thing is true in investment. You better invest in something which is going up and down rather than a straight line.
Considering that people have only seen one-way moves, I think they're not comfortable with the ups and downs anymore. I think that would be the reason as well. So, according to you, Abhishek, if you're looking at an investor who comes to you and says that I need a balanced approach in my fund or in my investing, who do you think for sure should invest in a Gilt Fund in terms of risk-taking capabilities as well? And what are some of the risks they should be aware of if they're investing here?
See, it's only the volatility risk you should be aware that there is a possibility in the short period of time you may see some amount of negative returns. Other than that, there's hardly any risk in this fund. And as I said, asset allocation is very important. For your long-term asset allocations, to balance your equity and high risky portfolio, Gilt Fund is one of the best bets, because when everything goes wrong, this is the portfolio which shines in most of the times and balances your portfolio in true fashion, and it has liquidity as well. Because when liquidity is not when you have it. It's when you need it. So at that point in time, you will get that liquidity, which is most important.
Okay, so what about returns in this case? You know, I was looking at the performance in general. Kotak Gilt Fund or other Gilt Funds, they've not been able to, beat the benchmark or meet that. Is this something that happens? It's usual for returns to work this way?
So unlike in equity market, fixed income markets in India are not that liquid. There are few securities which are called on-the-run securities. They do very well. And then there are large off-the-run securities that don't do very well. Now, in order to beat an index, you should be able to replicate it. Unfortunately, in fixed income indices, it's not possible to replicate because of lack of depth and because of on-the-run securities coming in index at the closing price and off-the-run going out at closing price. But there's no depth in the market to replicate it. So if you look at it, yes, some funds will outperform index once in a while when interest rates are falling and their duration is higher. Some funds will underperform when interest rates are high and duration is low. Over a period of time, will we be able to tag along with the indices? Answer is quite likely. And which is where Gilt Fund provides a convenient option to investors. The challenge with investors is twofold. As per RBI's data of financial households financial flow, in last 3 years, they have put about 9 lakh crore in currency notes. Now, currency notes is like holding ice on a summer afternoon. It's going to melt away. Why not put the money in Gilt Fund? They are liquid, they are safe, they have volatility, but the credit quality is as good as the currency notes, and it gives some return. The second challenge with investors is that either they drive the car in fifth gear or in the reverse gear. So they'll go straight and jump into F&O trading, or they'll put money in savings account and current account and bank deposits. Now you know that you have to drive car in all gears, and you don't go from reverse gear to fifth gear at one go. You take steps. So from current account, savings account, bank deposits, move to Gilt Fund. From Gilt Fund, move to hybrid funds like balanced fund, and eventually move into equity fund, and finally go into sectoral funds and small and mid caps and so on and so forth.
So you mean to say if somebody is starting out today, they should start with the fixed income side and then maybe slowly move along?
Absolutely. Learn the experience of mark-to-market volatility. As I mentioned, most funds NAV will be like ECG, going up and down. And it better go up and down, otherwise it may be Bernie Madoff's fund. So you want to experience volatility and then go into higher risk, higher return category.
Okay, makes sense. I'll come back to the other part of this question as well. But Abhishek, I want to understand with you, Gilt Funds is one part of the fixed income category. What are some of the other ways an investor can look at fixed income if they are starting their journey? What are the other categories one can look at?
So we have funds across the spectrum, starting from an overnight fund to the Gilt Fund, which is on the extreme end of the spectrum. But we have short-term corporate bond funds, which have maturities across your needs. If you have short-term needs, we have ultra short-term schemes also, or short-term, basically 6 months. Every 6 months or 2 years, 2 years, you have schemes which are matching your requirements, just like an FD. If you want to put in money for 1 or 2 year of your investment horizon, we have funds which are matching your investment horizon, which use predominantly corporate bonds and some sovereign securities, so that you get optimal yield which is risk adjusted and which matches your requirement. So we have funds across the spectrum, which is tailored as per your needs in terms of investment maturity profile.
Okay, and it's important to talk about it because while we talk about debt funds, there's just one category that people talk about. There's so much happening in the fixed income side as well. You spoke about how there is M2M volatility or mark-to-market volatility that we see in Gilt Funds, but over a period of time, it looks good. Considering the scenario that we are in, macros that we are in, do you think the returns on Gilt Funds could be better than equity markets right now? What is the idea that we are seeing?
See, the equity market has higher volatility and hence higher return potential. Gilt market has far lower volatility and hence will always have lower return than the equity market. But you try to create a balance between debt and equity, between risk and return. So today, in the near future, let's say 18 to 24 months, there will be very good chance for interest rates to go down as Fed will start cutting rates from mid-24. FPIs will start investing in Indian gilt because of inclusion in bond indices. The fiscal deficit is well under control, and in the vote on account at 5.1% was way below expectations. Put all these things together, we believe there is a big figure change possible in Indian interest rates. Government securities are starting with 7% handle. They'll become 6%. Some of the corporate bonds and PSU bonds are starting at 8%. They'll become 7%. And hence the longest duration, longest maturity will not only get coupon income but also capital appreciation. Could we be looking at a double-digit kind of return over next 12 to 18 months in long duration government securities? Answer is yes.
Okay, all right. So could be a double-digit return this time around. So we'll keep
Low
that.
double-digit.
Low double-digit. Okay, the expectations even in that case are so far away from each other.
Precisely.
You have to be so precise.
It's gilt we are talking about, not small and mid-cap stock.
I take that point, and thank you for that clarification. Otherwise, you know how investors work these days as well. It's a very interesting chat, but I do have to get into a quick break. So let's do that. Let's slip into a quick break. We'll come back on the other side and we'll discuss all about gilt funds and a lot more when it comes to mutual fund investing. Stay tuned for that. Welcome back. You're still tuned into Mutual Fund Corner. We have with us Nilesh Shah and Abhishek Bisen of Kotak Mahindra AMC. We are discussing about their fund completing 25 years, the Gilt Fund that is. Also, a lot about the fixed income investing and a lot more. Abhishek, let me come to you. We are talking about inclusion in the JP Morgan bond index. What does this mean for the fixed income market? If there are some numbers, how much inflows that would mean, and what would that mean in terms of interest as well?
Yeah. So JP Morgan has included IGBs into their indices. So it effectively means that the weight they have given, which will effectively start rebalancing June 24 onwards for next 10 months, 1% every month, they will be increasing the weightage in the index. So effectively, we are looking at around $25 billion flows. And if the overall funds start tracking even more, the amount can even vary. But ballpark number, as the market has been speaking about, is around $25 billion worth of flows. Now, it's a simple equation. When the demand goes higher, if the supply remains reasonably constant, the prices will appreciate the standard economics. So, which is what we are witnessing despite somewhat negative headwinds across. Still, the bonds are stable. We are seeing very well bid. Demand is reasonably strong, and the yields are decelerating in a well-behaved fashion. So, which is going to even aggravate the moment actual flow starts coming into June onwards, and we will see probably yields decelerating in most of the times till the time the rebalancing is happening from the JP Morgan side.
Okay, and your take, Nilesh, on the same. Do you think this is something that could bring back the focus, or do you think it's a big deal for the bond markets in general from an India perspective?
It's a very, very big deal. We remember our equity markets were Wild West in the early 90s or pre-90s. When foreign investors came in, they brought the governance, they deepened our market. The same thing will happen in the bond market. We are now becoming part of JP Morgan government bond indices and Bloomberg bond indices. It also paves way for path into Bloomberg aggregate bond indices. This should bring probably upwards of $50 billion over a period of time into Indian bond market. More importantly, it will create an alternate buying. And I think world needs our capital market. We need their savings. It's a win-win for both.
Okay, yes, it looks like that. Definitely. There's so much interest, not only in the equity markets, but the bond markets as well. You know, it's a controversial question, but I have to ask you, would you say that investing in a fixed income mutual fund would give you better return maybe than a fixed deposit right now? Because even though we have seen the increase in repo rates in past couple of quarters, it has not translated into higher fixed deposit rates. Is this something which would make investors look at fixed income mutual funds?
So never ask a barber, do you need a haircut or not?
I know.
So I'm always going to say a fixed income gilt fund or a corporate bond fund will always outperform equivalent fixed deposit. And that's mainly because in fixed deposit, banks have a high overhead. And hence, if they are earning X minus overhead, which is 3.5%, they'll pass it on to consumers. In our case, our overheads are 30, 40, 50 basis point. So whatever I earn minus that spread, I will pass it on to the consumer. On a risk-adjusted basis, mutual fund should outperform bank fixed deposit in most circumstances.
Yeah, well, we just needed the math on this as well. So maybe that's the reason I asked you that question. Abhishek, again on fixed income, because as I said, the viewers that we have, they want to understand more about debt funds or fixed income funds in general. Does the duration matter in the kind of category you are looking at in fixed income? Can you explain us to that? Short duration funds versus long duration funds. In a scenario or a macro like this, what should investors look at? You spoke about gilt funds would be a longer duration, but if they want to look at shorter duration, which are the categories they can look at?
So ideally what we recommend people to match your investment horizon in terms of duration of the underlying fund. What I mean is, let's say you're looking at a fund investment horizon or a traditional investment plan for 2 to 3 years, you don't know. So what you should go and look, which are the funds which are having a average maturity of around 2 to 3 years in a normal circumstances. But we are in a time where probably we have peaked in terms of interest rates, and there is a possibility that we will plateau for some time and the rates will start easing. So in such kind of circumstances, what we recommend investors is, if you have some amount of tolerance to volatility, and if you have still that 18 months and above investment horizon, which you don't know that what kind of extent you can extend it to, you go for highest duration possible. Because that is, in such kind of circumstances, what you are going to do is you are going to get the benefit of the duration, and the returns are going to be somewhere close to double digit, as we discussed. Over the
low double digit in the medium term.
Yeah.
That clarification will come again and again, I'm sure. But yes, go ahead.
I also wanted to highlight that in a fund, at one go, what you are going to get a diversified portfolio, and the liquidity is at most important. Because as a retail investor, you can be a 5,000 rupees investor, you can be a 5 lakh or 50 lakh or 5 crore. But if you want to create a direct portfolio yourself, you need at least 25 crores. That also, I'm not sure whether you'll be able to actually create a diversified portfolio. While a retail investor with a very small amount of money is at par with any institutional investor and can create equally liquid and a diversified portfolio, which is available for free in terms of you don't need to pay anything extra for that. So that is a very important part of gilt fund or any debt fund, which in an equity you can very easily do because one unit is tradable.
Yeah.
But in fixed income, it is not that way. It doesn't trade that way. So it is a very important part which people normally don't understand. So one should look
at that.
Look at that.
That makes sense. So, generally we do get this query often. We talk about SIPs in equities. Does SIP in debt make sense? Is that something the investor should do?
So, if you are doing asset allocation and you have a regular income, then SIP in debt makes sense. But otherwise, you can invest lump sum in debt fund. The fund manager is managing the duration. And as long as you give them sufficient time, they should be able to deliver decent return to investors.
Okay, so lump sum is the way to go because your fund manager is managing all the risks and the duration for you. Nilesh, I have to ask you because, while it is a fixed income discussion, but we are also seeing a lot of volatility. And the worry that we always see with investors is, should I withdraw? Should I take a pause? Should I just cash it out? What do you have to say to those mutual fund investors who have been very regular, but right now they are very scared?
Just follow the thermo of asset allocation. If you are overweight equity beyond your risk appetite and investment objective, please book profit. If you had sold in March 20 because of fear, because of panic, please book some profit right now. But if you are a long-term investor, you actually bought during March 20 COVID period, or you hold on to your positions without worrying about correction, then you have the risk appetite, then stay invested. The journey of our equity market is from $4 trillion economy to maybe 25 or 30 or $40 trillion economy. Stay invested for that course. Will we see ups and downs? Undoubtedly, yes. There will be corrections, but use that corrections to increase your allocation to equity. So one simple advice, follow the dharma of asset allocation.
That makes sense, and it has to be like the ECG, as you said. It will
Absolutely.
happen. That means the heart is beating, right? Abhishek, last few questions on the fixed income side. Apart from the mark-to-market risk, is there any other risk the investor should keep in mind, be it some of the risks associated with, not the gilt funds, generally, the credit risk, the liquidity risk? Is this something that investors should be aware of when investing in a fixed income fund?
Yeah, I mean, in terms of credit risk, of course, if they are choosing a fund which is having slight higher amount of credit risk, because there's something called YTM of the fund, which typically investors look at. Just like when you go for any traditional investment, you look at what is the return you're going to get. So something equivalent to that, we have something called YTM, which every investor looks at. Higher the YTM, people may get attracted towards, because the gilt fund will be one of the lowest YTMs. So if you look at a higher YTM, there is an element of credit risk, and that credit risk sometimes may trigger, may not trigger. You don't know. So one should be very well aware what exactly is that risk, and you should be able to appreciate if you're getting some 20 basis point or 50 or 100 basis point higher, why are you getting and what is the kind of risk associated. And most of the time it is not exactly just the credit risk. In the name of credit, there can be an illiquidity risk. So if you are able to hold your investment for the average maturity, then that liquidity risk gets taken care of. Because the portfolio is very well diversified. If there is a sudden pressure, there is a volatility. But if you are able to hold it, you will be able to get that YTM out of it. So these two things get taken care of. But the third thing, if credit event triggers, then it's difficult. But still, the diversification helps you there. If you are directly invested, then nothing is possible. But since if you are invested through a fund, the diversification takes care of that risk. So which is very well important, one investor should look at. While giving a direct, you become very much concentrated in one particular company or an asset, while in a fund you are very well diversified.
Okay, that's the asset allocation mantra that you spoke about as well. Gentlemen, it was such a pleasure speaking to the two of you. It was a masterclass on fixed income funds and gilt funds as well. Very helpful, and I'm sure the viewers will benefit from it as well. But with that, we'll take your leave on this edition of MF Corner today. Thank you so much for joining in. More news and updates will follow on the other side.